After a decade of falling interest rates, global financial markets are facing significant changes. Interest rates continue their march upwards and soaring inflation is being met, the slowing of central bank asset purchases and fiscal shocks, all of which are pulling in liquidity, the ability to transact without dramatically moving prices, out of markets. Violent, sudden price moves in one market and institutions holding investments on margin, face margin calls that require them to deposit more cash as collateral and forced sales of other assets, with unpredictable results. At the same time, policymakers are paying close attention to market plumbing and financial stability risks. With risks rising, investors are watching some bits of the market more closely than others. A rapid shift to higher interest rates is fueling dysfunction in Europe's money markets, threatening to undermine efforts to tighten monetary policy. The war in Ukraine has increased oil and gas prices, and most European governments have already intervened in the market by subsidizing consumers' energy bills. While support for both consumers and firms are necessary to manage energy market volatility, it is not solving the problem. The Bank of England joined the bandwagon of advanced economies in delivering a sizable 75 points interest rate hike. Nonetheless, a recession seems inevitable next year. The key question of how deep it will be depends on impending changes to taxes and government spending, the level of energy prices. Also the willingness of households to use their excess savings. Fears of a deep global recession with damaging consequences are misplaced. The risks to financial stability are very high, as a combination of high inflation, low to negative growth and tight financing conditions put pressure on markets and the real economy. That combination is bringing up some old vulnerabilities that have built up. The rising margin requirements in commodities, along with the intervention in the bond market by the Bank of England regarding pension funds, demonstrates over-leveraging is still a possibility despite post-financial crisis reforms. All remain to be seen. But despite the doom and gloom, there are reasons to be optimistic. The reforms instituted after the Great Recession have created a much more resilient banking sector. We learned the lesson from the global financial crisis. Here are increased financial stability risks, but luckily there is also increased resilience. While a mild recession in some of the world's key markets seem inevitable, such a rest could bring about some welcome change, even if it is disruptive for markets. Over-leveraging is still a possibility despite post-financial crisis reforms. While a mild recession in some of the world's key markets seem inevitable, such a rest could bring about some welcome change, even if it is disruptive for markets. This recession will still ultimately be costly for some firms and individuals, but rather than being really seriously damaging, I think it's more like to be a pause that actually refreshes. A mild recession will bring some respite to consumers who are facing these really challenging cost of living issues. Businesses could also see a return of the supply security missing since the pandemic began. A mild recession will actually bring some welcome change. Recessions are likely in Europe, the United Kingdom and the US, which technically has a recession already. But I am worried about something much worse than a garden variety recession, and I don't think that's what we're going to see. I think those fears are misplaced. Please subscribe to my channel and click the bell to get alerts when a new video is posted. You are welcome to write your comments, questions, or concerns you would like to share.